This is the London Fintech Podcast, bringing you practical insights and approaches, stories and inspiration from the innovators who are building the new world of financial services. This podcast is brought to you by NextWave, strategy specialists and solutions for financial institutions. Welcome to London Fintech Podcast. Today, we're continuing our exploration of markets digitisation driven by crypto and DeFi. And that's probably the biggest transformation theme right now alongside AI. We've had leading digital wealth managers like Betterment on the show. We've heard from the CEO of Algorand and private credit and digital asset firms like Fasanara in recent conversations. And today we have one of the world's largest and most innovative investment firms on the show. My guest today is the head of innovation at Franklin Templeton, Sandy Kaul. Sandy is a pioneer in melding finance with tech. She's one of the earliest innovators in putting regulated assets such as stocks, bonds, and money market funds on chain. She advises the CFTC on crypto market structure. She also sits on the World Economic Forum and the DTCC Digital Asset Advisory Boards, and she's leading Franklin's rollout of new tokenized products. And this conversation is extra special for me as we worked together back in the 2000s, collaborated on a token asset initiative in 2017, and it's a chance to catch up. Welcome, Sandy.
Thank you, Tony. Nice to be here with you.
It's great to see you. So, look, how are you? And for the audience, tell us a bit about Sandy, a bit of your background and what you've been doing over, really a very interesting career.
Yes. Well, thank you. Yes, I have kind of a crazy background. Yeah, started off as a reporter on the commodity markets, and I had my sources teach me about commodities right out of university. And within a year, I was writing an Outlook column about commodities, the commodities I was covering, coffee, sugar, cocoa, cotton, and frozen concentrate orange juice. And they would tell me what they thought was going to happen in the markets. And being a very uppity 21-year-old, I was like, I don't think so. I think you're misinterpreting the pattern here. And so they told me I was way too opinionated to be a reporter, and I became an analyst. And I joined one of the big firms, Shearson Lehman Brothers, and I was a commodity analyst for 15 years until I really became just fascinated. I became a portfolio manager. I stayed in the commodity markets, but I became fascinated with how technology was changing everything. And that's when I moved over and began doing consulting, first with the big internet startup Scient, right around the time the web was rolling out, and then with capital market specialist, MA Partners. And then I went from there on to really working with Citibank in their prime brokerage department, helping to redefine hedge fund consulting there, and started to do this thought leadership about how the investment industry was changing and evolving. And that's when I began to really think about what is the future of the industry looking like, and was writing about where new things were emerging, new service models. And by about 2016, it became clear that there was this whole set of disruptive technologies that was coming from the digital asset realm. And I published my first piece back then in 2017, telling people that basically tokenization was going to replace equities and bonds over time, which seemed like an outrageously ridiculous statement in 2017, but doesn't look so bad today. And that's really where my interest in this whole area emerged.
Yeah, and there's a journalistic theme that runs right through that. And I've been privileged. I've seen some of this firsthand when we were working on token asset collaboration. You were still at Citi, I think, with the Prime Group. Those reports were coming out, and they'd be sort of 96 pages of dense analysis, but really well written and written with one voice. And I remember saying to you, I said, Sandy, how do you do this? And you said, I think we interview sort of hundreds of CEOs and the team pull everything together, and then I just go and sit in a dark room for 3 weeks and write it.
That was about the process, yeah.
Is that still the process?
That's pretty much still the process.
Love that. I mean, but the result for anyone in the audience who hasn't seen, and I think these things are available certainly on institutional platforms, either the Citi reports and now, of course, the Franklin Future reports that you're writing. They really are best in class. It's an extraordinary piece of material. And I think what you're finding now is that some of those predictions are coming true.
Yeah, thank you. And thank you for being so complimentary about the pieces. Appreciate that.
Yeah, well, I've tried to read the latest report, which is 108 pages, and research for this conversation. That, I'm afraid not all of it's gone in, so you're going to have to guide me. But when you're not at work, well, what do you like to do to unwind? I think, if I remember rightly, again, you've got quite some interest in the arts outside of business.
Yeah, my best friend and I opened and ran a comedy club for many years in Manhattan. And so stay in touch with a lot of the comics and watch their crazy lives and their careers unfold, which is fun. But I like to do things a little closer to home. I like to do knitting. That's a great way for me. What do they call it these days? Grandma core. Doing going back to these old fashioned things, but it's a very good way to unplug. And I play games with my friends and like to swim and go to the beach. So just
Yeah. Keeping
normal
keeping
life.
busy, but it's good to have some time outside the office. I've spoken to a few founders on this show who sort of almost never switch off, but we've also had some quite interesting side hobbies that people are using to decompress. So
You have to
it's
turn off. You have to turn off.
the first time I've heard knitting on this show, though. So this is great.
Knitting very badly, and I have to admit, very badly, but nonetheless.
Well, it's all a learning process. Before we jump right into today's episode, a quick thank you to our sponsor, NextWave. NextWave is an award-winning consultancy that is helping many of the world's leading banks, investment managers, and insurers deliver on their growth, efficiency, risk, and control goals and transform their businesses. With a senior team who have come from MD-level positions in major firms like HSBC, Barclays, and UBS, NextWave has both the deep industry expertise and the hands-on capabilities in AI, data, and automation to drive real results. More business outcomes and less PowerPoint from the consulting experience, as their clients like to say. NextWave has moved 2-week manual processes to 5-minute agentic automations, rescued global banking regulatory control programs, and digitized deal platforms, sustainability, and regulatory reporting systems. And they do much of this with hands-on engineering capabilities on leading technologies, which include ServiceNow, Alteryx, Quantexa, and Camunda. So if a modern and specialist alternative to the big brand consulting model sounds appealing, one which covers the full life cycle of strategy specialists and solutions, but with small practitioner teams, rapid delivery, and a better price point, then perhaps you should talk to NextWave. Visit nxwave.com to find out more and get in touch. That's nxwave.com. All right, let's get back to the episode. So tell us a bit about Franklin Templeton. So for me, top down, one of the world's largest investment management firms. And I know, talking to you occasionally, but sometimes to your colleagues in Europe as well, the sound bites that I get is that the firm is really on the leading edge of innovation in the sector. And there's a lot that you're doing in digital assets. So sort of curious, has that always been the case, or have you sort of brought that with you? And where does Franklin sit in the sector?
Yeah, so it was a very interesting journey here because when I published that big report from Citi back in 2017, I was able to present the findings to a very extensive group of very senior people in the asset management industry. And most of them were some were intrigued, some were skeptical, some just thought it was silly. But one of the people who was the most engaged by the content was Jenny Johnson, who is the CEO of Franklin Templeton. And Jenny, it's an interesting situation because Franklin Templeton was founded by her family. She is the third generation of Johnsons who are running our firm. Our firm's been around about 80 years now. And she takes that responsibility very seriously. So she thinks much more multi generationally, I think, than your average asset management CEO. And she really saw that these new technologies, that she needed to understand them, that she needed to embrace them, that she needed to really prepare the firm for the next generation of folks who are going to come in and run the firm. So she became very fascinated, and I watched the progress of Jenny setting up the digital asset team here at Franklin Templeton. I engaged with them from their earliest days and saw the really tremendous progress they were making. So by 2022, I called her up and asked if I could come here and work with the team and join with the efforts that they were doing, because I felt it was just so important for where the industry was heading. And, it's great to have a wonderful point of view about the future, but it's a lot more fun to actually be able to act on those findings and really reposition our firm to be a market leader in this next generation.
Yeah, and you've been researching and leading in this space for what must be approaching 10 years now. I can sort of milestone this because when you were at City, you and your team wrote a piece which went under this, which I thought was quite amusing at the time, this label of Own It, which was token assets, which was a fractional ownership of a holiday home or an art collection or anything really that could be tokenized. And my technology team at the time did a wireframe and a concept piece, and you took it back to your firm. So I recall that very fondly, partly because we made a great little film about it, and it was such a head spin at the time. It was like, really, is this what's going to happen? And it has been quite some time since, but things are really catching up now. So, what's your take on where the sector's at the moment?
Yeah, so this is just an incredibly important, I think, tipping point moment for where we are. If you think about it, Tony, the financial market infrastructure that the entire global set of capital markets and payment rails run on was really devised back in the 70s. It came after the paper crisis in the 60s. They looked at the brand new emerging technology of the time, which was computers, and they designed the system. They immobilized and they dematerialized securities. They put into place these very important clearing processes where you had clearing organizations acting as the buyer to sell every seller and seller to every buyer to centralize that function. And they came up with this whole approach of book order entry where you settled firm to firm and then each firm had their own client records. And this has been the way we've run the financial ecosystem for the last 50 years plus. What we're seeing now is the first time that the next 50 years infrastructure is starting to come into focus. And we're really beginning the transition and we're beginning the migration. And it's not going to happen in 1 year or 2 years, but it's going to happen much more quickly, I think, than people anticipate. And it's going to feature the decentralization of the system we just centralized. So for the last 50 years, you can think of that as centralized financial market infrastructure. And now we're going to move increasingly to decentralized financial market infrastructure. And it's going to be, I think, a very exciting and important change. And it's going to really open up and democratize access to the financial markets, I think, for everyone in the world.
And it's another example. I love the sort of the framing and the clarity. For anyone who ever reads Sandy's material, it's often in very complicated things in plain speak and some really nice framing. And that sort of last 50 years, next 50 years, it was centralized and now it's decentralized. Even I can wrap my head around that. And it is an exciting time. It feels like everything's sort of happening at once. And just from reading the headlines and seeing what's going on, and it's been uh, a combination of stable coin uptake and meme coins, and Bitcoin's been there for a while, but now it's at record values. And then there's regulation coming in with the Genius Act and the prospect of all of this really going mainstream for a lot of institutions, a lot of payments providers now integrating crypto in their payment platforms as well, Stripe and others. And the assets themselves no longer really the frontier investments that perhaps they were labeled, and now going mainstream. That's kind of my characterization. It's sort of everything happening at once.
Yeah, that's exactly right. But I think underlying it all, right? So just to kind of go back to simple framing, right? Underlying it all is a really foundational change that people need to wrap their minds around. And that is for the last 50 years, we have been having an account driven system. So you and I, we probably have a checking account, a savings account, a brokerage account, a retirement account, maybe an investing account around that. We have lots of different accounts. We're moving away from the account based world to a wallet based world where we're going to have one wallet. That wallet is going to be able to contain all of our assets. It's going to contain the digital forms of money that we spend. It's going to contain the digital investments that we hold. It's going to hold our digital identity document. It's going to hold digital copies of the titles to the insurance policies and assets we own, right? It's going to really be the foundational piece of financial architecture for our lives. And all those things you mentioned, right? The stable coins are putting the cash into the new wallet-based ecosystem. Tokenized money market funds are putting the savings accounts into the wallet-based system. Now we're seeing tokenized stocks and bonds putting the investments into the wallet based system. So, this is what I mean by the migration. These feel like a lot of different things happening at once. But if you look at the underlying theme that ties them together, it's that we're starting to see the assets move away from the account based to a wallet based ecosystem.
So shift from account based to wallet based. And I think between us, we touched on quite a few use cases. Mine were a little bit sort of early crypto with Bitcoin and token assets, and you touched on some of the more recent evolutions. But the capabilities of Web3 and decentralized finance and crypto are, way beyond those early products and use cases, and really very far reaching. So what's possible now with these technologies, and how should we be thinking about how this revolution is going to play into our lives and commerce
Yeah,
more?
I think that there's three changes that are the most important, right? The first is that these technologies allow us now for the first time to really operate markets 24 hours a day, 7 days a week, 360 days a year, right? So we're used to in the US or in London or in Europe or in Asia, the markets open usually sometime on a Monday morning. They're open for a certain number of hours of the day and they close, and they're usually only open Monday through Friday. That is very much going to be seen as a 20th century model. We're really going to move to a model where markets are open all the time and people can trade all the time. So that's the first big change. The second big change is today, every payment that you make for a transaction that you do in securities or funds and the movement of those securities or funds into your account, they happen on completely separate sets of technology, right? And therefore, there is all sorts of reconciliation that has to happen. You have to move the payments separately, you have to move the securities separately or the funds separately. You have to always be reconciling to make sure everything is hitting the right accounts. There's often errors and you have to hold up trades. And because there's all of this back and forth and uncertainty, people have to put a lot of money up as collateral to cover these operational risks. So that whole need is going to disappear. On these rails, the payments and the assets, the payments and the securities move simultaneously and at once. Every time a transaction settles, it actually settles. It's not just settled in principle, it's settled in actuality. You have the cash in your account if you sold the securities or the funds, and you have the securities or funds in your account if you bought them. And that happens immediately. So you're going to get rid of all of these operational frictions and the need to tie up all of this capital that is there to protect against those risks. So that's the second big change. And then the third big change is going to be that there is a lot of assets that have a contract that governs how the asset operates. Think about any derivative contract or even any bond, right? Particularly if you have any kind of structured product. And those contracts today exist in either PDF or paper form. At best, you have a system reading the clauses and the covenants. And then you have a whole team of people whose job it is to enact those contract terms and make sure that all of the things that you're entitled to as an investor show up in your account. So again, huge numbers of people. This is their entire job in the current financial ecosystem. And that is all going to be replaced by smart contracts. Smart contracts are programmable pieces of code. So I can now embed the contract in the asset. So if I sell you a structured product, that contract is in the structured product. When it hits your wallet, all of the benefits that you accrue will automatically come into your wallet. They'll be automatically triggered by the contract. And if you sold it to a third person, that third person would then get all of those benefits. And it updates automatically. So that's going to take out, again, a lot of frictions in the system. So this is why we think this is such a superior set of technologies. It's really going to make things much more automated, much more intuitive in how they behave, much more real time, and operate without the need to post as much collateral to protect against failures.
Yeah, so there's immediacy, there's removal of friction and collateral overhead, and then there's the concept of smart contracts. And I know when we were talking about real asset tokenization, the idea there would be maybe the smart contract would say, if I'm buying, a 10,000th of your holiday home, I've got an entitlement to stay there for one weekend a year or something like that. You program the rules in, right? And if it's a financial product, it might, the coupon rate for a security would be in the smart contract, and it would self-execute on the blockchain, and your entitlement would automatically vest, from that piece of code. So that's kind of it. And you do talk a lot about wrappers and rails. So I guess the rails are the blockchains and the wrappers are the smart contracts.
Or the tokens. The tokens are really the wrapper, and the smart contract sits
Okay.
inside the token.
Yeah. And so who is this all for? So, we're all familiar with the meme coin and the crypto bro and the Bitcoin sort of community on one level, but the institutions are getting in on this, and then there's corporate treasuries and sort of, so who is this all for? Maybe it's for everyone.
Yeah, I think it's for everyone. I mean, look, the crypto bros, they got there early, right? And what they're doing is very speculative, right? They're trying to find the projects or the blockchains or the applications, that the protocols that they think are going to be the most successful, and kind of ride that wave. With meme coins, it's all about identifying, virality, right? Are you going to be able to hit something that's going to go viral, and then you get in and you get out very quickly? It's a very short term way of thinking, but it's still the same principles of market value. It just happens in a much shorter time frame. But I think that where this is heading is that this becomes a financial infrastructure for everyone. Right. So today, as an individual, it's very difficult for me to trade derivatives. Like if I want to trade futures, I need to get all sorts of special permissions. My broker dealer has to do all sorts of extra due diligence on me. If I want to lend my securities, I can't personally lend my securities and get revenue for that. I have to pledge my securities to someone else who will pay me maybe a little bit, but they take a big chunk of that. It's very intermediated. If I want to loan my securities if I want to put my securities into a liquidity pool and take advantage of having extra liquidity, I can't do that. See, these are all things that only big institutional players can do today in the financial markets. And these are all things that you or I or anyone who's participating in these new blockchain based rails will be able to do, because the rails themselves remove these obstacles. It's much more of a permissionless structure where you choose to join. And even as regulators think about this, my guess is that they're going to let you kind of self-select your desire to participate in these pools. So we're already seeing pressures to lower the thresholds on accredited investors here in the US and allow them to opt in if they have passed certain tests. And I think that's going to increasingly become the approach. And we're going to open up the potential of the financial ecosystem to everyone.
So for institutions who are onboarding with new asset classes and perhaps want to take advantage of things like intraday liquidity that come with the digital products, what's the onboarding path and barriers? Because I can understand how I might go get my digital wallet, but if you're corp treasurer of Big Co, do you get a wallet for the organization, or what do you do to onboard with this, with the infrastructure for all of this?
Yeah. So, what we've started working with big organizations to do is they will onboard a master wallet. And then what they will do is they will tie wallets for all of the different legal entities that they need to operate in within that master wallet. They'll have kind of a master and then a sub wallet system where they control the keys. So the keys in this new wallet-based system are basically just what they sound like. You need the key to open and close the wallet. So they will control their keys, and they will have kind of their own internal network set up on the public blockchain so that they can access all those wallets. And to the world, all they see is a series of numbers and letters, and they might see some of the transactions that go in or out of that wallet, but they don't know who owns it. They don't know what entity those trades are being done on behalf of. So, this is the way that it will operate in the future. The keys, owning the keys, is going to be the way that you control all these wallets. But then you can move assets between all these wallets. You can move payments, you can move assets seamlessly, seconds, less than seconds in some cases, to move between all these different entities. If you think of today, a corporate treasurer and the difficulties they have in moving money cross border, this idea that I can just initiate a transfer as easy as I can transfer money between my checking and savings account, right? I can initiate that kind of transfer cross border if I'm now a corporate treasurer or someone who's managing a big multinational corporation and needing to manage my supply chain. These are going to be very huge improvements in the way that they can manage their organizations.
Quite a few things to wrap your head around. I want to talk about understanding and literacy for a minute. We see this in the AI space, and we talk to lots of firms that we work with on the consulting side about where they are on the AI journey. And there are folks at completely polar ends of the innovation curve, right? Some who are just sort of watching and saying, "Well, I don't really know what AI will do for my business," and not doing anything. And there are others who are all in and hands on keyboards and have built their own models and building agentic workflows and the rest. And sometimes in the same organization, you have
Yeah.
that polarization. And we've already touched on wallets, keys, tokens. And I know that if we start talking about particular blockchains, we'll end up talking about gas and staking and things like that. There's a language there. And clearly, as you've already explained, a new model of decentralized finance and on-chain accounting. A lot to wrap your head around if you're someone who's in, I think it's called TradFi, traditional finance, investment management. So how much do you think the investment management community understands the new asset classes, the new rails, the new possibilities here?
I think that the understanding is starting to grow, right? I think when it was just cryptocurrencies that you could trade in these wallets, it was harder for people to understand. I think from a branding perspective, calling these things cryptocurrencies was terrible because it makes people feel like they should be a currency and you should be able to buy and sell things with them. And that's really not their purpose, right? When you think about Ether, which is the cryptocurrency that drives the Ethereum blockchain, which is one of the largest blockchains, it's really the token you need to purchase block space to record your transaction on the blockchain. That's its only real purpose, right? Its purpose is to enable people to buy space on the blockchain to record their transactions. And so I think that as people start to understand that these cryptocurrencies actually have a function, and the function is to actually support the business model of the blockchain, and that business model makes money, actually makes a lot of money. Ethereum had over 10 billion in revenues, and they were the third fastest company in history to get to 10 billion in revenues, just behind Facebook and Google. So there's real business models here. And as people are starting to understand that and understand that these things are not meant to be currencies, they're meant to be basically business operations, I think that you're seeing more comfort in getting into the space. And then, of course, this idea that I'm going to tokenize equities or tokenize private equities in particular, like Robinhood is doing in Europe, right? That's very appealing to people who have trouble accessing those private markets. And I think that's going to really ignite more and more interest.
And like any new business operation, it needs the appropriate architecture and the rules, rails, platforms, foundations, data, all of those things to be put together. So one of the things I wanted to cover with you a little bit is how do you put one of these together? So if you're an institution, you want to be the next Franklin Templeton and be on the front foot with being a player in the digital asset space and be able to create your own products. How do you put one of these things together? Because I think, and I had a quick look at the timeline for Benji. I'll use that as an example. I think that's probably the best example because it's your tokenized money market fund. I mean, you'll correct me, but I think you were presented to the regulators 6 years ago for this, right? And you launched it last year. So that's quite some run up. How did you put this all together and what's involved?
Yeah. Well, so, you have to, I mean, it's getting easier and easier, right? When we created Benji, which was the first tokenized money market fund, we actually filed for that in 2019. We launched it in April of 2021. So it took about 2 years to get it through. The SEC had us run a side by side pilot for quite a period of time, showing how we administered this tokenized fund on the public blockchain versus the traditional mainframe based transfer agent system. And it was only after we were able to demonstrate that we actually had superior record keeping on the public blockchain that they got comfortable with us running this fund solely on the public blockchain. So that fund has been running 24 hours a day, 7 days a week 365 days a year on the public blockchain since February of 2022. So almost 3.5 years now. And we're getting close to 800 million, sorry, in assets under management in that fund. So it's starting to get traction and really begin to build in terms of its usage in the marketplace. But, that was a long journey because it was one of the first products to market. Since then, we've launched other versions of our tokenized money market fund. We launched a UCITS-based version and set up a transfer agent in Luxembourg. That took us about a year to get that from concept to launch. We've launched a private fund version of a tokenized money market fund for institutions to use as collateral. That took us also about 9 months. So the time to market, getting these products to market is shrinking. And I think that what will happen is eventually we'll get to the point where there's a smart contract for every type of fund that you're launching, and you just fill in the contract terms and you can launch the fund. So I think that, those timelines will continue to condense, and it will become easier and easier to put product out into this new wallet-based ecosystem.
Yeah, and the construct for these, if I get it right, you have a Franklin central blockchain, which is the system of record, but you're plugged into public blockchains, which are, I guess, distribution. So yeah, I can go onto Solana or Ethereum and buy tokens in the money market fund. Is that kind of how this put together?
Very close, very close.
Close.
What we've
2000.
actually built is the transfer agent. So that
Yeah.
is the function that actually, if you buy a share or I sell a share, we update the shareholder record, and we keep those records on public blockchain. So we don't have our own blockchain. We've actually plugged our system into. We're actually out on 9 different blockchains right now, and we have wallets for each investor on every one of those blockchains so that they can operate on whichever of those blockchains they choose. So we are very much engaged with the public blockchain ecosystem. We've also integrated with one private blockchain because there's some client requests for that. But blockchains, think of blockchains as just where you keep your ledger, and then all the functions that you do that create transactions for that ledger. That's the technology that we built at Franklin Templeton.
How do you choose the blockchain? So there's thousands of blockchains out there. They're probably, and again, from my limited research on this, some will say they're greener, some will say they're faster, some will say they're more secure, and some are more architected for coins, and some for supply chain logistics or whatever the use case may be. But how do you choose which chains from the very many? What tech, what platform are you going to put these institutional products on?
So there's really 3 generations of blockchains. If you think about, it's not been around, it's only been around since 2009, but we're already seeing 3 different generations. The first was, of course, Bitcoin, which was the original blockchain. And Bitcoin was very revolutionary, but it was very limited in what it could do as a blockchain. And now you're seeing lots of innovation happening in the Bitcoin community to extend the functionality of that Bitcoin blockchain. Then you had the generation that came out with Ethereum and some of the early blockchains. And these blockchains were a vast improvement in terms of being able to do more on top of them, but they couldn't balance both speed and security, right? They could either be very secure or they could be very fast. And therefore, they went for security because this is a record keeping system. You need your records as secure as possible, but they didn't have as much speed. And now there's a third generation of blockchain where they've solved some of that. They've kind of redesigned it from scratch. And these blockchains can do unbelievable amounts of transactions per second. They're very, very fast. But all that said, there are still several criteria that we look at in selecting a blockchain. We need to really understand how well supported is it? How many nodes do they have of people doing transaction verification? Because the security of a blockchain relies on there being a very robust community of people doing transaction verification. Everybody kind of keeps each other honest. So you need a lot of diversification in who is verifying transactions. You need to understand what is the token model of that blockchain? How do they incentivize the people doing transaction verification? How have they designed some of their contracts, their smart contracts to interact? So there's a bunch of criteria we look at, I'd say, but the most important is really, you want a blockchain to be as decentralized as possible. So some players are now saying, oh, we're launching our own blockchain, we're launching our own blockchain. And that all sounds good in theory, but those blockchains are not going to be as secure. They're not going to be potentially as decentralized. And that creates risks in our view. So we're really looking to, if you think of these blockchains as they're going to become the record keeping systems for the entire world, you want that to be as diversified, as decentralized, and as secure as possible. And that's really what we look for.
Yeah, and certainly in a highly regulated industry, as you explained. So, okay, so we've understood what's possible. We've understand the different types of blockchains. We even know how to put one together now. So we're all set. Talk to us about tokenized funds versus stable coins, because stable coins is a big thing out there, and that's really gaining huge adoption as a means of payment, store of value. But tokenized funds is slightly different, and perhaps you can unpack that for us.
Yeah. So, if I'm carrying around some pounds in my wallet, or if I'm carrying around some dollars in my purse, right? And I pay for a taxi with those pounds or those dollars, right? That's a very different kind of transaction than if I use a credit card, right? That when I use a credit card, there's much more of a record of that transaction. There's much more of people know who I am. There's a check as to whether I have as much credit as I'm supposed to have. There's a degree of ID protection that comes to me as the person using that form of payment, right? So a stable coin is really like cash, right? That it is a way of taking cash out of the traditional account-based system and bringing it into the wallet system. And that is what we are seeing with stablecoins. It's a way of getting cash into this wallet based ecosystem. And I can use that cash then in the form of stablecoins to buy investment funds, to buy Bitcoin, to participate in DeFi lending protocols, to buy derivatives, right? It gives me a form of payment. I can buy gaming rights with it. It gives me a form of payment to use to get to all the functionality in the wallet based ecosystem. So it's the cash, right? And it creates liquidity. But when you think about a tokenized fund, even something as simple as our tokenized money market fund, that is a regulated security, right? That when you buy that, it is backed by an organization that has had to register, who has to go through compliance checks, who has the regulators certifying that they're running a business that protects its customers, right? So you're getting an investment, and that investment oftentimes comes with protections that you don't get as a stablecoin. And so these new tokens, like the tokenized money market fund, or a tokenized equity, or a tokenized private equity share, right? These are new in a way because it's now in a token, and I can use that token in more ways than I could use those shares, right? I might own shares of Tesla today in my retirement account, but I can't use those shares very easily, right? I couldn't necessarily pledge them very easily to take a loan. I couldn't really put them forward to be able to participate and give my shares to a market maker and participate in some of the fees they get for making a market around Tesla. These are things that are just not possible for me today as an individual. But if that share is in a tokenized form, I can start to do all those functions because those functions are available in a permissionless way to anyone in the token ecosystem. So it's the same investment in a new wrapper, but that wrapper has much more utility, and I can actually earn more revenues and do more things with my investments once it's in that tokenized form.
Yeah, and if those tokens are for money market, then you earn yield, which I think is real time. And then I guess if it was equity, you'd have the same for dividends. And that's quite different to the end of day traditional model.
Yes, exactly.
Yeah. Okay. So Just switching tracks slightly, because Franklin's a huge investment manager. This is all about investment portfolios and portfolio management itself. So, what does the crypto revolution, the advent of all these new products, rails and wrappers, what does that really mean for portfolio management? And I'm just sort of leading into this. I know that you've written about this quite a lot, and you talk a lot about better living through investing as a sort of era that we're moving into, which is characterized by personalized services and portfolios, and almost a coaching role of the investment manager in the future. Perhaps you can talk to us about that, and how this is all that's enabled by everything we've been talking about over the last few minutes.
Yeah. So this is where the exciting part starts to all come together, right? So today I might have a portfolio, and in that portfolio, I might own all sorts of companies, and I get the financial benefit of the appreciation and value of those companies, and I get the financial benefit of any dividends that they might pay, but I don't get much else, right? One of the things that's exciting about the new rails that we're moving on to, if I go back to that earlier concept I was talking about, that I can put a contract inside the asset, right? So now think about I'm buying Amazon stock in my tokenized portfolio, right? Amazon can put a contract inside each share of stock that says, anyone who owns their stock gets a free membership for Amazon Prime, right? So rather than paying $140 a year, I get a free Amazon Prime membership because I own Amazon stock. So that's a nice little benefit. That just saved me $140. I could probably have a nice dinner out on that. Now let's keep taking that concept more forward, right? I now own, shares of Tesla in my portfolio, right? Well, maybe when I go into a Tesla dealer, I'm going to be able to get the friends and family discount on my purchase of a new Tesla. This is already the case with Ford Motor Company in the US, but people don't know that, and it's hard for them to prove that they own those shares of Ford stock. But if Tesla is tokenized and it's sitting in my wallet, I can just pull up that token. It will have the contract embedded in it. There will probably be a QR code. And when I show it to my Tesla dealer, they're going to honor that discount for me on my new Tesla. Well, that's probably a savings of several $1,000s, right? Now take that even further, right? I am looking at, really being able to bring in ownership of a big insurance company, right? I now own stock in one of the big insurance companies. And when I go to negotiate my next insurance contract with them, be it life insurance or home insurance, maybe I start to get a discount or a preferential rate on that insurance policy because I'm a owner of that company's stock. So each of these benefits start to add up so that the way I live day to day, I'm getting rewards from being a investor that today I don't get, right? I get rewards today if I hold a credit card, but I don't get rewards if I am an investor. And so being able to embed all of these contracts and have this be a self-executing system, right, makes that super easy for me to start to really provide people the benefit of how they live through what they own in their portfolio. And I think that as we move in that direction, working with my financial advisor and that financial advisor working with the asset manager who's putting the portfolio together, I start to point some of those investments towards things that Tony's going to really enjoy having in his life so that the benefits that you're getting matter to you. Right. So some of the benefits you'll get just because they're general benefits, but some of the things you might want just for yourself. Right. So I think this is where portfolios become much more personalized. They become much more efficient because they're giving you either cost savings or they're giving you extra benefits or early access to new products or services, right? It becomes a way that my life becomes easier and more interesting, and things are just given to me because I'm an investor. They're actually showing me appreciation. I'm providing a resource and I'm getting rewards back for it.
Yeah, and presumably for the issuers, they can equally differentiate and personalize. So I think I heard you talk on this one, taking the Amazon example in the other direction, they could conceivably issue a token on on the AWS business and a different one on the shopping business. And then if you're investing, you could choose where you wanted to invest.
Well, and I think as the benefits become more important to you, they might want different kinds of tokens with different benefits for different audiences, right? If I'm a giant multinational corporation, I might not care whether I get a free Prime membership, but I might care a lot if I get, 2% off my service contract for my AWS infrastructure, right? That's a huge benefit if I'm a big institutional player. So I think that you'll see more specialization in how they issue investments so that you can really get those rewards to be targeted at the audience that really needs them.
How do you think traditional funds are going to fare with all of this going on if they are off chain in this new market? And how quickly do you think they need to be paying attention and getting on board?
I kind of look at this as the next stage of what we saw happen with the ETFs, right? We saw ETFs come out, exchange traded funds, and exchange traded funds, particularly in the US and now increasingly in Europe and Asia, they started to displace mutual funds, right? That AUM started all assets under management started all moving out of mutual funds and into ETFs. And that didn't mean that mutual funds have disappeared, but they account for a far lower percentage of all of the investments that are out in the market. And it's becoming harder to raise new money in a traditional mutual fund or UCITS fund structure. I think the same thing is going to happen with these tokenized funds and tokenized offerings, is that they will rapidly begin to displace existing investment products, and those investment products aren't going to just suddenly disappear, but the ability to keep raising new assets in those structures is going to get harder and harder. More of the new money is going to go into these newer types of portfolios. And you're just going to hit a point where if you're only offering the old products, it becomes very hard to stay in business over time because you're just not attracting new assets.
Yeah, so sort of incremental ramp down and ramp up.
Yes.
Um, yeah, I can see that. And you touched on regulation. So just coming back to that quickly, compliance being built into tokens. I mean, this is sort of relevant, I think, in the context of Genius Acts and recent regulation. How does the regulatory framework look?
Yeah, the regulators will become more and more adept at operating in this new environment. The biggest change for them, Tony, is going to be right now, regulation is a backward looking function, right? They see a pattern emerge of something that doesn't look quite right. They go back, they investigate, they figure out what happened. It's very forensic, right? That is going to change, and they're going to actually be in the flow of transactions as they are occurring. And that is going to give them a new data set that, together with all of these new forms of AI that can really crunch that data, these huge amounts of data in real time, that's going to start to trigger opportunities for them when something looks like it's going wrong as it is going wrong. Right. And I think that that is going to make regulators much more efficient at rooting out illegalities in how markets are operating. But I think it's also going to require regulators to really rethink their technology, rethink their approach, and really start to bring in more types of talent that are going to be able to realize that it's going to become not a forensic, but a real time data driven process.
I love that. Actually, and I haven't heard that one before, but sort of the opportunity for the regulators to get on the front foot and have real time signals and visibility of what's going on. Uh, it's a nice mirror to what's happening in the market. Sandy, you're very good at telling the future, as we realised, because you've been brave enough to put that in writing and then wait and see what happens 5-10 years later. What are your predictions from here? For obviously for the crypto space and for the sector.
Yeah, I think that this regulation and this rule set that allows us to move on to the new rails is going to happen a lot faster than people anticipate, right? So I used to think it was going to take us probably 5 to 10 years. Given the speed at which I think things are actually moving, I think that 3 to 5 years, we will be hitting that point that we spoke about, Tony, where assets are flowing out of traditional investment products and into these tokenized products at a pace that starts to slow potential capital raising in traditional products. And so I think that this is going to be a real race over the next 5 years. Firms that today have not begun to think about a wallet based strategy and tokenized products are going to have to play catch up very rapidly. And I think firms like ours, where we're advanced in building these new infrastructures and operating in these new environments, will see a tremendous advantage in our capital raising as this transition starts to take place.
Yeah, and how quickly? So in the AI space, I'm hearing that the model capabilities are doubling every 4 months, and that may or may not be the case. But the ability for the institutions to sort of double their capability to adopt and integrate is more like a couple of years. And there's some rule of thumb out there that it's roughly a sort of 18-month innovation cycle, sort of try, fail, learn, go again, and you need to do that to bring the organization up to a capability level to really be able to adopt the new technology. Do those models sort of play into the crypto space as well? And does that mean that major firms, is it this year? They've got to be building stuff, or have they got a little bit of time to think about it?
Well, I think you're going to see more and more firms announcing they are thinking about it, and they are starting to either build stuff or create
Yeah,
partnerships. Like, I think that the sense of urgency is beginning to rise. My guess is that maybe the top 20% of market leaders are already thinking or planning. I think by this time next year, that's going to be the top half, 50%. And within 2 years, the bottom half are going to start to be panicking and trying to play catch up as fast as they can. I think it's going to happen very, very quickly.
that is in this sector. That is fast. Okay, so what's your next report going to be on?
We're actually looking at retirement in the workplace as our next report. There's been so much innovation and so much advancement in the types of products that people are being offered in their traditional investment portfolios. But when you get into retirement accounts, particularly in the areas of the world that are moving away from defined benefit to defined contribution, there has not been as much innovation. And so I think that, we've kind of relied on target date funds for a large number of years to kind of play the role of preparing people for retirement. And a target date fund is really, if you think about it, it's a one factor fund. The only thing that they're factoring is what year you're going to retire. That's a very poor set of customization criteria when you think about how complex different people's lives are and how many variances there are around what kinds of obligations people are going to have in retirement. And so I think you're going to see a massive increase in this idea that I need to build a retirement portfolio for each individual person based on what their retirement scenarios really start to look like. So that's going to be what we look at in our next report.
Yeah, and so I'm sure a lot of research and prep going to be going into that one, so I'll look out for it. And just as we sort of draw this to a close, advice for those who are in trad investment firms at this stage?
Learn, right? I mean, I didn't know anything. You didn't know anything. No one coming from traditional finance knew anything about this infrastructure or this ecosystem or how it operates until they started learning, right? And so learn, right? We in financial services, I think, are the most adaptable industry I've ever seen, right? There is never a challenge that we haven't risen to in terms of being able to digest and understand the opportunity and isolate it and rebuild to capture it and rebuild our businesses around it. So I think that this is just one of those moments where you need to challenge yourself to stop being a skeptic and take a step back and understand that this is a tech driven change. It is all happening because there are new technologies that operate in new ways. And every time we've seen that, we've seen massive changes in how firms architect themselves and deliver their products and services. And we're just on the verge of yet another iteration of.
Yeah, and it's a sea change. And so for the rest of us who don't work in financial institutions, but maybe thinking of investing in crypto, and you might not be able to answer this question, but it's a fun one anyway. If you're thinking of investing in Bitcoin or Ether, where do you think those currencies are going to go? Because there are some schools of thought out there that we're still only at the beginning in terms of.
Yeah. I mean, I think they're going to go up. I don't know how far. I'm not really, there's lots of good models that our investment teams build
Yeah.
that probably could give you a far more precise answer. But I do believe, right, just take one step back. I think that these are going to become the record keeping systems for all the companies and all the individuals all over the world. So just think about that for 1 second. Like if every company was putting all of their records onto the same ledger, the people who own that ledger are going to be making, they're going to become the owners of one of the most important assets in the world. And because the way they have set this system up, you and I can be owners of that ledger through buying the tokens, right? And that's the way I think of it as, if the world is moving towards these global ledgers, I want to own the global ledger if I can.
Brilliant. That is a big idea. So for anyone made it this far in the conversation, the real golden nuggets, perhaps at this end of the conversation. Sandy, anything you're listening or reading at the moment that you might want to share with the audience?
Well, everyone in the crypto world is obsessed with the Fourth Turning book series. So if you have not read it, it's a very, very, very interesting kind of study of sociology and human generations and how one generation's attitudes and focuses stimulate the next generation in some type of backlash. And if you look at the pattern of this by the fourth turning, which they say we are currently in, there's always this whole rejection of the old world system that is playing out. And so, you see that in so many different facets of our lives today. So I think it's a very interesting book. And I take some comfort from it because as we get through the fourth turning, we start the cycle again. And that's really bringing us back into a period where there is much more harmony and much more sense of unified purpose. And that would be nice given the way the world feels day to day today.
Okay, well, we'll look that one up and put it in the show notes. And, you know, on the topic of reading interesting things, I mean, as we noted, top of the show, you are a very prolific author yourself. I mean, these are corporate reports and latterly lots of things that go out on LinkedIn. If folks want to find out more about you or Franklin, where would you say they should go?
You can check out my LinkedIn profile, or you can go to our ft.com site. We have a whole institute section where you can read about all of the things that we've been talking about on the show today as part of our disruptive technology section on that site. So it's all available to the public. So please check it out.
Yeah, brilliant. Thank you, Sandy. Look, thank you for sharing your valuable time and insights for us today. As I said, extra special for me because we sort of know each other, and I feel like we've sort of caught up on a decade of history through the course of this conversation, as well as unpacking some really interesting things and hopefully demystifying the crypto sector for the audience. So we'll call time there, and yeah, if you want to know more, get in touch with Sandy. And I hope you enjoyed this episode. Thank you very much.
Thank you.